Hey guys, Peter Harper, Managing Director and CEO of the Ascena Family Office. For those of you who are not familiar with the business, we are a multi-family office that is focused on US direct investments and mergers and acquisitions for private clients and family offices. So in the last video, we touched on the intersection between family offices and private equity, and the rise of family offices. We talked about the rise of family offices over the last decade. Throughout that process, we really touched on, or partially touched on, the notion of family office direct investment, right? So why family offices have really grown to prominence, particularly in more recent times. So today we wanted to address at a deeper level the idea of family office direct investing. So what is it? How do family offices think about it? What are the risks associated with it, right? And why should you care about it? Okay. So, for those of you who are new to family office world, the way in which families think about asset allocation really stems across 6 different areas. They're looking at investing in public equities, fixed income, traditional real estate, whether that's into a direct asset or in through some sort of fund structure. They're probably looking at hedge funds, definitely looking at private equity, and they are almost definitely looking at direct investment. So that is investing directly in either a private owned business or in some form of real estate structure. So direct investment has really grown to prominence as a primary tool of investing for family offices because of the perceived inefficiency associated with investing via fund vehicles, where family offices don't have as much control to the underlying investment. So what's triggering this is just the sheer volume of capital that has been injected into this area, into this space over the last decade. Recent report by Goldman Sachs put it that currently is something in the tune of 50% of the world's private capital is now allocated through private or by private family offices into private market or alternative investments. The reason for this is because when you invest via a fund vehicle or indirectly, there can be layers and layers of fees, so that it ultimately will reduce the return of the investment. If you have the right team in place, if you're going via a fund vehicle, you're getting less control, over the investment, right? So the rationale for direct investment is overall better efficiencies, so higher returns, and more control and involvement in the investment process. So less surprises, right? There can also be a lot of tax benefits. Any time that there is one less layer of structural complexity between the capital and the asset, you're generally going to see operating efficiencies, and so both returns and tax can play a role in why family offices are more attracted to directs. So how are family offices today sourcing direct opportunities, right? So personal networks, often they're relying very heavily on their personal networks to source deals. However, as a firm who specializes in private market deal sourcing, I can say that there's a huge amount of work that goes into creating adequate scale around a personal network to source deals. You need to look at a lot of different deals, right? You need to be very clear around what it is that you want to invest in and what you don't want to invest in. And then you need to have the internal skills within your organization to underwrite, whether the investment should happen, right? So the biggest one's personal networks. A lot of folks are still going via investment, maybe sourcing deal opportunities via investment bankers or brokers, right? Maybe it's less common for family offices today because for a lot of families, they're either looking to build out the internal skills to underwrite and find opportunities on their own, or they're working with a fractional family office like the Ascena family office to make that to do that work. The larger families might have, that are in the business of doing deals, might have pretty sophisticated direct outreach programs, right, to find opportunities. But I think for the most part, it's going to come through professional networks, right, and being out in market, telling folks that, hey, we want to do deals and we're ready to invest. So what are the risks, right? A lot of opportunity, better returns, more efficient structures. What are the risks? There's a number of risks. The biggest one is probably, or most common we thought of, is probably liquidity risk. Direct investments normally come with a longer term investment time horizon, right? The reason why a lot of folks like direct investment over fund structures is fund structures tend to have a limited lifespan. It might be 5, 7, 10 years. At some point, regardless of how an asset's performing, they might trade it. Whereas if you're directly in the opportunity as a family, right, and you like it, but it's just not going the direction you wanted to go at the same time horizon, then you opt to stay in it regardless of where things are at. So, but you're in an investment that might be heavily illiquid, so trading out of it can be challenging. Concentration risk. Normally the reason folks are investing via fund vehicles is because they want to be diversified across a bunch of different assets that might have the same sort of thematic. If you're direct into a deal, so you're more heavily concentrated into one opportunity rather than a basket of opportunities, then you've got concentration risk. If the deal doesn't, you might get bigger returns, but if the deal doesn't work out, you're potentially going to lose more money. Operational risk. Right, when you're going direct into a deal, it really is about buying into an operating asset. So that's either an operating business, right, where your management team, the success of the management team is the success of the deal, or it's piece of operating real estate. So the same outcome with a piece of operating real estate, you're only as good as the folks that are running the asset. And then the final point we just had here was around valuation risk, right? With illiquid assets, again, it's a lot more difficult to understand where the valuation of an asset might be at any given time, right? So you need to have these systems in place to be able to ascertain that relatively efficiently at the right moments in time. I wanted to just touch on a little bit about the sort of interaction of direct and co-investing, right? So ideally, I think a lot of family offices would be not investing in fund vehicles and would be doing primarily directs, unless the family's at a massive scale. Certain family offices get to a particular size where going direct just becomes inefficient because they cannot efficiently get the capital to work, right? But for most families, one of the attractions to investing in funds today is because they will also then get an opportunity to co-invest, right, side by side with the fund. So if they cut a big enough check to the fund says, yeah, I'll let you go directly into the deal with extra money. So they're going to ink out a better return because on that direct co-invest, there's likely not going to be any fees, right? So for family offices, the ability to co-invest alongside a very sophisticated private equity firm that may have done all the underwriting of a transaction, right, is of significant value, right? Because it can de-risk capital that's being deployed on a substantial scale. So benefits, obviously you are increasing your diversification. So rather than just being concentrated in one asset, part of your capital is still going to go into a fund vehicle and get into a bunch of different assets. You're going to access significant expertise inside of the private equity firm that may be more sophisticated than your in-house folks. You're sharing the risk with another investors that's got a significant balance sheet normally, and then you're getting access to exclusive opportunities. A lot of deals that are coming that are being sourced via the more exclusive and better performing private equity firms are harder to access, right? So if you can get access to them, then it's a far more efficient process. And then finally, I just wanted to touch on some of the what are thought of as direct investment strategies for family offices. And some of this might seem pretty straightforward, but these are the things that family offices are thinking about. They're thinking about whether they should be doing a sector or asset class focus. So some families are just saying, hey, listen, we're only going to invest in real estate. We're only going to invest in a subsection of operational real estate, venture capital, private equity. Most of them have a long-term focus, right? Because they're going direct. They're more focused around the long-term benefits of being in direct deals. They're active owners, right? So by investing on a direct basis, they want to get integrated with the board. They want to be closer to the operations of what's happening so they can keep a closer eye on their investment. As we talked about before, if there is an opportunity to go into a fund vehicle and co-invest, right? They look at that as a very valuable tool to tighten up execution risk, right? And then some folks are in all of this would just prefer to lend directly to an organization rather than invest equity. One, it might give them senior rights in the capital stack. And, they're generally going to get superior returns. They're getting superior returns to what they might be getting in the equity with a lower degree of risk. And then finally, for the larger families, they are very geographically dispersed as far as their focus, right? They're looking at opportunities all around the world because they understand when it comes to diversification, it shouldn't just be asset focused. I mean, having a diversified approach that considers the impact of varied geographies is important. So then how does one get into the game, right? Families need to invest in investment policy statement. What is their protocol for getting into directs? It's a really, really critical document, right? You need to think through what makes sense. Clear framework for investment decision making needs to be set. You need to bolster your network and how your network thinks about you as far as sourcing high quality deal flow and your ability to execute on those deals. And then you need to be prepared for long-term commitments, right? Being direct is not designed for those who need short-term liquidity. Okay, thanks guys.